Last Tuesday night, I couldn't sleep. I'm lying there staring at my phone, watching my portfolio bounce up and down like a yo-yo, and I'm thinking, what the hell is happening to the stock market right now? Here's the thing, the market is incredibly fragile right now. Every piece of news makes it jump 2% or drop 2%. Just last week on October 10th, President Trump posted about tariffs on China, and the market lost $2 trillion in a single day. $2 trillion gone. Just like that. And I know you're thinking the same thing I was. Mike, how am I supposed to invest in an environment like this? Do I buy? Do I sell? Do I just hold and pray? Well, I'm Mike from Golden Goals, and in the next 10 minutes, I'm going to walk you through exactly what I'm doing with my money right now, based on real data, not hype. And I'll break it down for 4 different scenarios. So whether you're 5 years from retirement, already retired, 20 years out, or sitting on a pile of cash right now, you'll know exactly what to do. Let's dive in. All right, so here's what's really going on in the market right now. Okay, so first, let me paint the picture of where we are right now. Mid-October 2025. The S&P 500 is sitting around 6,600 points. Over the past month, it's actually dropped about 0.5%, but here's the crazy part. It's still up 12.5% from a year ago. So on paper, that sounds great, right? But here's what's keeping me up at night and what you need to understand. The market is overvalued. Not just a little, significantly overvalued. We're seeing valuations that remind investors of the dot-com bubble back in 2000. You know, when everyone thought internet stocks would go up forever, and then they didn't. Tech stocks and AI stocks especially are trading at insane multiples. Companies like Nvidia jumped 2% in a single day this week, just because TSMC raised their revenue guidance. That's great for the short term, but this is the kind of easy money mentality that has historically ended badly. Add to that, the Federal Reserve just cut interest rates by 1/4 point in September, bringing the federal funds rate down to 4 to 4.25%. They're doing this because job gains have slowed and unemployment is ticking up. Translation? The Fed is worried about the economy slowing down and they're trying to cushion the blow. So we've got overvalued stocks, a fragile economy, volatile news cycles, and interest rate cuts. What does this mean for us? It means we're likely going to see some flash crashes, maybe even a sustained dip of 15 to 20% before the end of the year or early 2026. But here's the key. That's not necessarily bad if you know how to position yourself. Okay, let's talk about scenario 1. If you're close to retirement. All right, let's start with scenario 1. You're about 5 years away from retirement. You're close, but not there yet. You can't afford to lose everything, but you also don't want to go so conservative that inflation eats away your purchasing power over the next 5 years. Here's what I'm doing, and what I think you should consider. First, I'm staying 90 to 100% in equities. Yeah, I know that sounds aggressive for someone close to retirement, but hear me out. The bulk of my portfolio is in a 3-fund setup: S&P 500 for broad market exposure, SCHD for stability and dividend income, and QQQM for growth and upside. Why? Because we're probably going to see a dip, maybe 15%, maybe 20%, and those dips are going to be the biggest gift of your entire financial life if you're ready for them. So here's my strategy. I'm continuing to dollar cost average most of my monthly contributions into the market right now, but, and this is critical, I'm holding back 10 to 15% of my cash in a high-yield savings account earning about 3.5 to 4%. That's my dry powder. When the market drops 15% or more, I'm throwing that cash in. Let me give you a real example. Let's say you have $5,000 a month to invest. Put $4,250 into your core portfolio right now. Don't wait. But keep $750 in cash. Over 6 months, that's $4,500 sitting there, ready to deploy when everyone else is panicking. That's how you win in volatile markets. The worst thing you can do right now is go hyper-conservative and pull everything into bonds or cash. More people lose money anticipating a crash than actually riding through one. Stay the course, but be smart about it. Scenario 2. You're already retired. You're living off your portfolio and maybe some Social Security. This is a completely different ballgame because if the market crashes and you have to sell at a loss to pay your bills, that's devastating. You can't get that money back. So here's what I'd do if I were in your shoes. Priority number 1, have 2 to 3 years worth of living expenses sitting in a high-yield savings account or money market fund, completely outside the stock market. Let me break down what that actually means. Let's say you need $80,000 a year to live, but you're getting $40,000 from Social Security. That means you need to pull $40,000 from your portfolio each year. So 2 to 3 years worth means you need $80,000 to $120,000 in cash reserves. That's your safety net. Why? Because if the market drops 20% tomorrow, you don't have to sell a single share. You can live off that cash reserve while the market recovers. That's peace of mind, and it's how you protect yourself in volatile times like right now. Now, for your actual investments, I'd go heavier on value stocks and dividend payers. Companies like those in SCHD, VYM, or FDV. These are stocks that pay you consistent dividends and tend to be less volatile than growth stocks. But don't go 100% conservative. You still want some exposure to growth because AI, technology, and other sectors are going to grow over the next 10 to 15 years. You just don't want to bet the farm on them. Here's a solid model. 10% in short-term treasuries like SGOV for absolute safety, 50% in dividend-focused ETFs like SCHD, 25% in broad market ETFs like VOO, and 15% in growth ETFs like QQQM or SCHG. That gives you stability, income, and upside, all balanced. All right, here's where it gets interesting, if you're young like me. Scenario 3, you're 20 or more years away from retirement. You're in your late 20s, 30s, maybe early 40s. You're making money from your career, not your portfolio. This is your time to take advantage of compound interest and volatility. First things first, pay off any high-interest debt. If you've got credit card debt at 20% interest, pay that off before you invest another dollar. You can't out-invest 20% interest. It's mathematically impossible. Once that's done, here's what I'm doing. I'm going aggressive but smart. I'm investing in both retirement accounts, Roth IRAs, 401ks, and a regular brokerage account. Why both? Because retirement accounts give you tax advantages, but you can't touch them until you're 59 and a half. A brokerage account gives you flexibility if you want to retire early or just have options. As for what I'm investing in, I'm going with a balanced 3-fund approach. 1/3 in SCHD for dividends and stability, 1/3 in the S&P 500 for broad market growth, and 1/3 in growth ETFs like SCHG, QQQM, or VUG. Now, I know AI and tech stocks are all the rage right now. Nvidia is up huge, everyone's talking about it. But here's the thing. Every time there's been easy money, people have lost their shirts. In 2000, it was internet stocks, then the dot-com crash. In 2007, it was real estate, then the housing crisis. I'm not saying AI won't be huge. It will be. But I'm not betting everything on it. I'm diversifying. If you want a little extra risk, add some VGT, Tech ETF, or SMH, Semiconductor ETF, but keep it to 10 to 15% of your portfolio max. At your age, you can handle volatility. If the market drops 20% tomorrow, you've got 2 decades to recover. In fact, you should want the market to drop so you can buy at a discount. This is the time to be aggressive, not conservative. Okay, final scenario, and this one trips up a lot of people. Scenario 4, you just got an inheritance, a bonus, or sold a house. You're sitting on a lump sum, let's say $100,000, and you're thinking, when do I invest this? Do I throw it all in today? Do I wait for a crash? Here's the brutal truth. Nobody has a crystal ball. I don't. You don't. Nobody does. So waiting for the perfect time is a losing strategy. More people lose money by sitting on the sidelines waiting for a crash than by just investing. Statistically, time in the market beats timing the market. A study by Vanguard showed that lump sum investing outperforms dollar cost averaging about 2/3 of the time. So if you want to throw it all in today, you're probably going to be fine long term. But here's the problem, psychology. Let's say you invest that $100,000 today, and 3 weeks later, the market drops 15%. Your portfolio is now worth $85,000. That's going to hurt. You're going to wish you waited. I've seen this happen to so many people. So here's what I do, a hybrid approach. Invest half of your lump sum today, no matter where the market is, even if we're at all-time highs. Then take the other half and dollar cost average it over the next 5 to 10 months. Using our $100,000 example, put $50,000 in today. Then invest $10,000 every month for the next 5 months. Or if you want to be more conservative, invest $5,000 a month over 10 months. This way, you get some money working for you immediately, but you also get the benefit of averaging down if the market dips. This approach gives you the best of both worlds: statistical advantage of lump sum investing, plus the psychological comfort of dollar cost averaging. And honestly, that peace of mind is worth more than a few percentage points of extra return. All right, let me bring this all together for you. Look, I get it. The market feels scary right now. It's volatile, it's unpredictable, and every headline makes it swing wildly. Just this week, we saw the market gain 0.7% one day because of strong bank earnings, then almost give it all back the next day over trade tension. But here's what I've learned after years of doing this. The best investors don't try to time the market. They position themselves for any outcome. They have a plan. They stay disciplined, and they take advantage of volatility instead of running from it. So whether you're 5 years from retirement, already retired, 20 years out, or sitting on a lump sum, you now have a plan. You know what to do. The question is, are you going to execute it? If you found this valuable, hit that like button and subscribe to Golden Goals. I'm putting out real data-driven content like this every week to help you build wealth and financial freedom through dividend investing. Drop a comment below and let me know which scenario you're in and what your biggest question is. And remember, the best time to plant a tree was 20 years ago. The second best time is today. Let's get to work. I'll see you in the next one.